liquidity. So historically, Bitcoin has been one of the purest liquidity plays. So when you look at various measures of domestic or global liquidity, when liquidity is rising, that's pretty good for Bitcoin. And when liquidity is falling, Bitcoin's usually going down or sideways. And starting around the beginning of Q4 of last year, some of the liquidity indicators started to bottom and turn back up, at least temporarily. And I think that, much like other assets had a rally, I think Bitcoin would have had a rally back then, if not for the whole FTX debacle. And so that kind of delayed the rally, but with that somewhat resolved, and now kind of moving forward, I think Bitcoin and other aspects of the ecosystem are kind of having their rally, which is really a liquidity rally. And so basically liquidity indicators look okay for the next couple of months, but overall long term, they're still not in a very good place.
Bitcoin swapped bullish gains for chop into January 31st as the end of the month saw nervous price action. The stakes remained high for traders long and short, with the monthly close just hours away. This was followed by interest rate decisions from the United States Federal Reserve on February 1st, along with the European Central Bank a day later. With volatility likely lying in wait, liquidations mounted despite Bitcoin maintaining a fairly narrow trading range. The trip to $22,500 sparked $46 million of long liquidations on January 30th, which according to data from CoinGlass was the highest daily total of 2023 so far. Hello and welcome to Money Talks. In today's video, Lyn Alden updates about her outlook for Bitcoin in 2023. She also breaks down the importance of regulatory clarity in the space and how it will drive the future of institutional adoption in crypto.
Yeah, so I kind of pointed that out as like something that no one should trade on that specific thing, but it's more like an observation. And that part of the underlying causation, that correlation, is that generally that's the market kind of assessing that the Fed's getting close to being done its hiking cycle. And so that's kind of what happened last time, where when the 2-year rolled over the Fed funds, that ended up being the top of the hiking cycle, and that ended up marking the bottom of Bitcoin. So right now I think we're seeing shades of that. It doesn't mean that it's the exact bottom. It doesn't mean that the bottom's guaranteed in. But I do think that the part of the downward move in Bitcoin that was specifically from the dollar rally, I think that's kind of behind us. And now I think we probably have a longer grind ahead of us to, kind of start rebuilding from here. But I think when you look in the second half of this year, there's still some liquidity concerns. And so kind of like how in the prior Bitcoin bear market, you had the major bottom in, say, late 2018 into 2019. That was the big bottom. But then you kind of had like a later liquidity shock through March 2020, where you went down and went up much faster. That was again, another liquidity issue. I would be surprised something like that, like a sharp retest, but it's too early to say because it partially depends on what humans do, what Jerome Powell does, what different policymakers do. And of course, that's always impossible to predict. So I think there's still big things like that can move the crypto specific industry. But overall, like historically, Bitcoin has been very correlated to macro factors and specifically liquidity. And I've looked at it over the past couple of years because a lot of people, they look at the halving cycle. That's obviously got some degree of correlation. But then if you look at, say, Bitcoin and the Purchasing Managers Index, which is one of the leading macro indicators, generally when it's rising, it means the economy is expanding. Growth is accelerating. When that's going down, growth is decelerating. If it goes below 50, it's essentially outright contracting. And generally, Bitcoin's rather correlated with PMIs. It usually runs a little bit ahead of PMIs. Like it usually front runs it a little bit. And then I looked at it and saw that basically liquidity generally front runs PMIs. And Bitcoin tends to be very correlated with that liquidity. And so for the past 3 cycles or so, it's already been somewhat of a macro asset in that sense. But of course, if you have a big enough industry-specific blowout, like we saw with FTX and like you might see with some of these others, that can temporarily override the macro factors because, it doesn't matter if liquidity is good if there's some massive forced selling whale out there.
Further data from on-chain analytics resource Material Indicators, meanwhile, highlighted the tense situation on the Binance order book. Bid and ask liquidity remained in flux, with incremental shifts up and down having a tangible impact on BTC price trajectory. Bids just below $22,000 and asks at $24,000 kept BTC USD in check.
I think most are, Russia already talked about it, how certain payments could be made in it. I think they view it generally as too small. Right now, Bitcoin's less than like $500 billion. Yeah, just this like volatile, free floating one. And so the way that I noticed the way that academics or economists often approach this is it's like not exactly as they vision. They're like, oh, that can't possibly work. And so I think it will probably keep being dismissed for a while until it's too big to ignore. Right. So right now, all the major powers are looking for these more like, specific agreements, whereas Bitcoin is more like the people's money, right? It's kind of the people's like global settlement asset. And I think it's going to be the case for a while. And, if Bitcoin gets to a point where it's a multi-trillion-dollar asset, and the volatility starts to reduce because it's more widely held, that's when I think that more and more nations will be like, wait a second, maybe we can use this as a reserve asset. Maybe we can use this as a payment system. I think it's just still too small and volatile for it to be on most of the radar in a truly serious way. So there are a lot of ways to slow it down. I think that the lowest hanging fruit would be to cut it off from the banking system. And so the way that, say, in the United States, we have the First Amendment, and we have other kind of protections that have been successfully used to, defend the use of encryption, defend the use of code as speech, right? So it's pretty hard to tell people that you cannot run a full node open source software, that you can't, memorize 12 words, that you can't, flip a coin 256 times and generate a private key, right? It's very hard to enforce on that level. But it's really easy to tell banks that you can't send money to crypto exchanges or brokerages, or fiat on ramps into Bitcoin and crypto and things like that. And so that's kind of the big lever that could be pulled by the United States, by Europe, and by some of these other major countries. And it depends in part how short-sighted politicians are, right? Because on one hand, they might want to pull that, be like, no, we're going to defend ourselves against this like rising, like, decentralized currency. We're going to shut off the on ramps to it. But then you also drive out businesses from your jurisdiction, right? So if the United States does it, but Australia comes out or another country comes out and says, build all your businesses here, then it basically, in the long run, is probably not going to be good for that. We saw, back in 2018 and for years since then, India was exploring that, right? They were like, kind of flip-flopping between maybe we should ban all this. And then it's like they kind of realized like you don't actually ban it, you just ban yourself from it, which can maybe work temporarily, but it's not really a good long-term strategy. And so overall, I think that the biggest impediments are just restrictions on privacy, attempts to make it harder to self-custody your asset, as well as kind of the potential giant attack would be to sever it from the banking system. But that'd be a pretty major event.
After jumping to new heights for 2023, Bitcoin and Ether retraced a portion of their recent gains. The primary downside catalyst appears to be investors' apprehension over the upcoming FOMC decision on interest rates, and similar pullbacks are also being seen across the stock market, which is down. After the January 18th announcement that the United States Department of Justice levied enforcement action against Bitslato and ramped up pressure on certain players in the crypto sector, Binance started to block certain users' accounts.
Most of the indicators point that we are like early stage recession or late stage expansion. So a lot of the leading indicators like, conference board leading indicators, purchasing managers indices, those things are rolling over. Industrial production's rolling over. Inflation-adjusted retail sales are rolling over. In the strong area, as you point out, has been the labor market. Historically, that is a lagging or coincident indicator, meaning that by the time unemployment is rising, you're usually already in a recession. And that's part of the reason why those two negative quarters were kind of a full recession, is because unemployment was still pretty low and not really worsening yet. Even in the labor market, though, we're starting to see that some of the early indicators there are not looking good. So, for example, if you look at overtime hours, those are on the downtrend. If you look at temporary help, that generally is a more volatile leading part of the overall labor force, because imagine if you're a small business and you're running into tight times, you might reduce your temporary help service before you would let go permanent employees. And so those are actually down year over year. And so basically there are multiple small signs that the labor market's cracking, which combined with all the other indicators, inverted yield curve, contracting PMI, it kind of points towards likely recession. But I think we're still in kind of either the pre-recession stage, or they always declare a recession months after it happens. So it's possible that this is like already part of the recession. But if it is, we I think still really early stages.
So what are your thoughts about Lyn Alden's prediction? Tell us in the comments. Also, don't forget to like and subscribe. See you soon with the next video. Thank you so much for watching.